Okay, welcome back. 90 points, 23,300 is where we are at. Nikhil Ranka is with us, CIO, Equity Alternatives at Nuvama Asset Management. Nikhil, good to have you back on the program. Thanks very much for your time. So first, a market view, Nikhil, because, this entire episode of big FII selling started. I remember it was a turning point and we had a conversation and you were early on it. Do you have a definitive view on how this will pan out? It's muddy and unclear. What's the view?
So good afternoon, Prashant, and thanks for having me on the show as always. If you remember, in the month of October when we had turned a bit cautious on the markets, from October onwards to now, we have seen close to $25 billion of selling in the Indian markets. And at that point of time, if somebody would have said that, we will see $25 billion of selling and markets would be down just 10-12%, you would be very happy with the outcome. Now, what has happened is, in October, the same thing had happened with Chinese markets, where FIs were significantly underweight that markets. And at the slightest positive news, there was a scurry to add on to positions in that market. The same thing has happened over the last 3-4 months with the Indian markets, where FII positioning is now at a 15-year low. In terms of data points that we typically track, if you look at the FII positioning on index futures, they are now short to the tune of close to $2.5 billion. And another interesting data point is, after a long time, we have started to see the GIFT Nifty trading at parity to Indian Nifty. So typically it used to trade at a discount of 20 to 30 points, which was indicative that there was shorting pressure from FIs. But now we are starting to see parity between the two, and that's the first sign that probably FIs will now start covering their short positions. If and that happens, I think the up move can also be equally swift in the markets. The second point is, if you look at the earnings outlook, the rupee depreciation has given a natural cushion, I think, to the earnings downgrade cycle. Because if you look at IT and pharma sectors, it's a dollar P&L over there, which gets multiplied by eventually the rupee dollar rate to get at the final EPS outcome. The rupee depreciation of 3% and some bit of margin benefits because currency has depreciated by 2.5-3%. Would mean that there could be some upgrades in IT and pharma, and therefore our view is overall the risk of earnings downgrade from these levels for the markets is extremely low.
Nikhil, hi, Rima here. But we've seen some wild moves in IT this time in the earnings season. TCS went up 5%, HCL Tech tanked 7-8%, perhaps more, and today LTTS. It's not that the numbers were completely out of whack compared to expectations. But we've seen some big moves. How do you position yourself on IT now?
So, Rima, what has started to happen in IT now is more than the numbers, people are starting to watch out the commentary of the management. So in the specific instances that you have told, TCS earnings were weak, but management said that they are seeing first signs of discretionary spending coming back. In the case of LTTS also, they have very clearly said all the three verticals should start seeing some growth. And therefore, the reactions are more than numbers, a function of what the management outlook is. Wherever we are seeing that management commentary is extremely good for the next 2-3 quarters, in spite of numbers being subdued, we are seeing stocks reacting on the upside. My sense is IT should more be a consolidation band. One, because they have not corrected as much as the broader market has corrected. No doubt there is some cushion from the rupee depreciation that has happened. And therefore, to that extent, from an overall perspective, the view is that the upside could probably be restricted to single digit in most of the IT names. But on the downside also, I don't think that these stocks will, fall 10-20%. I think it's a trading band of plus 10 to minus 10 in IT stocks. That's the broad outlook that we have for IT.
Okay, hi Nikhil, good afternoon and good to see you, Ben. What about the ones that are not for the faint-hearted? OMCs, it's all probability Q3 is going to look blockbuster. Though the prices are indicating nervousness still, and you have crude oil prices that are spiked up yet again. So how do you approach OMCs, and what about specialty chemicals? I recall there was this phase that everyone was jumping in, and then those stocks saw very, very sharp drawdowns, 20-30% on a couple of names as well. What's your view on both these two?
So, good afternoon, Nigel. So, on OMC specifically, if you look at it, Nigel, the street has got concerned because crude oil prices have moved from $72 odd to $82. Now, if you look at the sanctions that have got imposed on Russia and some of the tankers, the total quantum of crude oil that is at risk from these sanctions is close to 2 million barrels per day. If you look at the OPEC spare capacity, that's sitting at close to 6 million barrels. So even in a worst case, if we assume that these 2 million barrels do not find alternative routes, because the last time also this thing had happened through some way or the other, this eventually hit the markets. Our OMCs also enjoy discounts as high as $10 to $12. But I am saying leave that apart. Even if this doesn't come into the markets, OPEC has enough spare capacity to pump 2 million barrels and stabilize the markets. And therefore, our base case is eventually the up move in crude will not sustain. Crude should head back down again. And therefore, at these levels, two things are positive for OMCs. One, if in the budget we get some element of subsidy for the LPG losses that they are suffering, the estimate is anywhere from 30 to 35,000 crores that they should get reimbursed for LPG losses. Then obviously numbers will start looking very good. And most of the OMC names are now trading at close to 4 to 5 times EV EBITDA on an FY26 basis. So as and when we see crude starting to reverse, I think the up move can be equally swift in these counters. Anyways, our view is from these levels, given that GRMs also are showing strength, the downside in these names is extremely limited from the current levels. On specialty chemicals, Nigel, specifically on the refrigerant space,
yes.
We saw that up move. There were talks that there are price increases that these companies are contemplating, and obviously if that happens, there's a potential 20% EBITDA increase that can happen for some of these names. But a large part of it is actually factored into valuations because most of these stocks are trading at close to 25 to 27 times FY26 EBITDA. On the agrochemical space, we still feel that there is pressure on margins and the outlook there has not changed so significantly. So we are not positive on specialty chemicals, focused more on the agri side in that sense. But yeah, some of these names I would say on dips will start to look very, very interesting.
Right. Nikhil, for those who are not constrained by sort of, running a portfolio, right, and who can and who kind of more flexible in what they can do. Just as an approach this year, do you think it'll be it's one of those years where you're going to see lots of ups and downs and more trading kind of market, or you think or you think it the steady move higher and higher that will return at some point? What's your sense?
So, Prashant, historically, if you have seen, Indian markets have delivered compounding in the range of 11 to 12%. And the maths for that is very, very simple. You have 6-7% of real GDP growth, 4-5% of inflation. So, on a nominal basis, we've compounded our GDP at close to 11-12%, and that is the historical stage year of Indian markets. Last 4-5 years were exceptionally good for us. We have seen returns in the range of 18-19%. And so to that extent, we will have to temper our expectations that the market returns will again start looking more in the range of 10 to 12%. Having said that, our view is that 23,000 to 25,000 should be a near-term range for the markets over the next 6-7 months. And I think what everybody is looking for is what happens when Trump assumes office on 20th. If we do not see any ugly tariff wars in the first week of him assuming office, then obviously that will soothe a lot of nerves and markets can start to rally back again. So I think a lot of things will get clearer in the next 7 to 10 days as to which way the geopolitical things are moving. And once that happens, I think the extreme and heightened volatility that we have been seeing in the last 2.5 months, that should subside because anyways, even if you look at the positioning in the markets, the single stock HNI futures open interest, which was at close to 1,65,000 crores, has now come down more closer to 1,30,000 crores. So there has been reduction in speculative positions that were there in the markets. And to that extent, the market is looking much lighter now as it was as compared to 2-3 months back.
Okay, so a broad range, 23 to 25 on the Nifty, and more clarity in the next 7 days or so. One thing is clear, it's going to be lots of news flow. How much of it will be consequential for markets over the next 7-10 days, we'll have to see, as Nikhil pointed out. Thank you very much, Nikhil, for joining us. Good speaking with you and good conversation, as always. Now, Reliance is set